Equity Market Update, January 2020. In January 2020, Indian markets fell by approximately 1.5%, driven by rise in geopolitical tension between Iran and US, concerns due to rapid spread of coronavirus in China, revision of India's growth forecast by IMF, partly negated by optimism around finalization of trade deal between China and the US. For the month, mid and small caps outperformed large caps significantly. Sectoral performance was mixed, wherein healthcare and capital goods outperformed, while metals, oil and gas, and banking underperformed. Globally, equity markets were also under pressure in January 2020. Most indices globally delivered negative returns. FPIs remained net buyers in the month and bought equity of $1.7 billion in January 2020. Total FPIs equity inflows in 10 months of FY20 have been $9.4 billion as against outflow of $7.2 billion during the corresponding period last year. Net inflows in domestic equity-oriented mutual funds were INR 4,017 crore in December 2019 compared to net outflow of INR 4,304 crore a month ago. For FYTD 20 till December 2019, total flows in domestic equity-oriented mutual funds stood at INR 38,036 crore. Out of the Q3 FY20 results declared so far, corporate banks, pharma and cements were better than expectations, whereas retail banks, NBFCs, consumer staples, telecom and utilities were largely in line with the expectations. Results for information technology, metals and media were below expectations. Summary: 2019 was a challenging year for the Indian economy as it faced both external and domestic headwinds. On the external front, the uncertainty due to trade tensions between US and other major countries, especially China, adversely impacted the global trade and hence global growth. Locally, issues like slowdown in discretionary consumption, drop in auto sales, concerns over large NBFC's financial position, low growth in aviation traffic, weak industrial production, falling capacity utilization, etc. added to the slowdown. However, we believe that the slowdown was mostly attributable to cyclical factors and there are signs of bottoming out emerging. The key contributor of slowdown, auto sector, is showing some stabilization and thus should support growth in FY21. Further, the resolution of cases under Insolvency and Bankruptcy Code should boost investments as supply of ready assets reduces and companies will have to start planning for new units for growth. Also, new owners of IBC assets are likely to incur capex to optimize efficiency of the acquired assets. Further, recently announced budget and number of policy actions taken in the last few years are likely to start bearing fruits and help in economic recovery led by investments. We are also observing some early signs of pickup in economic activities with Manufacturing Purchasing Managers Index (PMI) accelerating to an 8-year high and Services PMI to a 7-year high in January 2020, improving incremental credit to deposit ratio, etc. Outlook: as on 31st January 2020, Nifty 50 is trading at price to earnings multiple of 17.7x based on FY21 estimated earnings and 14.9x based on FY22 estimated earnings. These are reasonable multiples, especially in view of improving profit growth outlook. While discretionary consumption has slowed down, it directly impacts stocks whose weightage in Nifty 50 is less than 15%. Markets thus hold promise over the medium to long term in our opinion. With the sharp decline in mid-caps and small caps since the beginning of 2018, significant divergence with large caps is not likely going forward. Further, DIPAM Secretary recently mentioned that exchange-traded funds, ETFs, are going to be the less preferred route for divestments going forward. This should lead to better valuations of PSUs, as regular supply of shares through ETFs was a big overhang on their share prices. Further, it is worth noting that the gap between 10-year G-Sec and 1-year forward Nifty 50 earning yield has reduced significantly, and it is now below 10-year average. This indicates that equity markets are attractively priced. In view of the above and expected recovery in earnings, there is merit in increasing allocation to equities in a phased manner, or in staying invested, as the case may be, for those with a medium to long-term view and in line with individual risk appetite. Adverse global events, rise in crude oil prices, sharp moderation in equity-oriented mutual funds flows, delays in NPA resolution under NCLT are key risks in the near term. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.